I'm Paige Soya. Welcome to High Stakes. I'm managing director of K Street Capital, and this season is all about exits. So today we have Marcus Brauchli, who's one of our longtime investors and also has his own fund separately and has experienced all kinds of different exits. So I think this will be fun. I know you've been on an episode before, Marcus, but maybe it's worth just a quick intro again for those that started on season two.
Sure. Thanks, Paige. It's great to be back. It's always good to be with you discussing these issues. I'm Marcus Brauchli. I am the co-founder of North Base Media. We are a venture capital firm that has been focused on media and technologies related to media. We've been around for about 10 years. We do early stage investing. I spent my career in media. I was a editor and a journalist, ran the Washington Post newsroom and the Wall Street Journal newsroom, and then worked for the Graham family that owned the Washington Post and did some work for them around digital media and strategy before I started North Base Media with my colleague Sasha Vucinic. So we've been around 10 years. We've probably learned a lot of lessons, as in made many mistakes that might be useful to other people. And I'm happy to talk about them.
Yeah. So why don't we start with that? Just the whole variety of exits that you've seen in your as an investor in your investor career. And I know that you've been a K Street investor for a long time too. So you've probably seen some interesting angel exits as well as, the deals in your fund.
True. K Street's been actually a great sort of parallel experience because, I make my mistakes over here and see like all the clumsy bad things I do in our world. And then over here, I see K Street Capital and K Street, which you've been managing for a long time, seems to actually avoided a lot of the mistakes.
Not all of them, but some of them. Yeah. Yeah. You can't, you
So,
can't get away from all of them. But I know you're talking about this earlier, but the whole flavor, all the flavors of exits that you've seen, and then maybe we can focus on a couple that you think might have the most interesting takeaways.
yeah. So, there's a lot of different ways you end up getting out of an investment. And, I can't say that I was ready for all of them when we started down this path, but, obviously some things are going to fail. They get wound down. And lesson there, I learned the hard way. Don't forget legal documentation for tax purposes. Whenever one of your investments is winding down, be sure to consult your tax advisor to find out what you'll need in order to be able to get some credit from the loss that you're going to take on that investment. And that matters. We invest internationally. And so for us, getting the right kind of documentation turned out to be important. And it's something that people should be mindful of. Another thing to think about on the international side is when a company gets taken over or gets acquired and you get bought out, somehow make money on your investment. You also need to be prepared to have real documentation. And really importantly, in many countries of the world, they do withholding. And if you are getting withheld from a, in on your profits in a country, sorry, where the U.S. has a tax treaty, you may need to have tax residency certificate from the U.S. in order to be able to claim back the taxes that are withheld in that country.
Most countries do that, or is that like a certain subset?
But I can tell you, most countries, I can tell you, it's happened to us. And when a country withholds taxes, if there's a tax treaty with the U.S., you can apply to recover those taxes. If you're paying taxes in the U.S., you don't have to pay the withholding taxes in that country. But you need tax residence certificates to do that, which the IRS is supposed to issue. But the IRS has been overwhelmed for years now, thanks to the pandemic and certain political party in Washington, which thinks it's a good idea to underfund the IRS.
In retrospect, and this is a side tangent, not about exits, but now that you've been an international investor across lots of countries for a long time and have seen all these intricacies, do you think it would be better to focus just in the US where it's simpler, or is it worth all the trouble that you have to go through with all that
The
stuff?
US is definitely not always simpler. There are certain aspects of doing business in the US that are simpler. Like you can set up a company in Delaware incredibly fast. You can register, but US tax law is not simple. The regulatory environment in the US can be complicated if you become a big enough investor and you have to deal with registration with the SEC. There are ways in which the US is not a simple market. In fact, one of the challenges we had early on, we raised money. We were talking to investors outside the US, and perfectly reasonable investors outside the US don't want to actually invest in the US because we may think of the US as a stable environment, but to the rest of the world, the US looks like it's constantly changing its policies, which, by the way, it kind of is. And you can't be sure that the US at any point isn't going to decide to change a policy that might affect you. So investors, there's a reason that the entire offshore tax world exists. It exists because there are investors who would like to be invested in the US, but they don't want to have to put up with the vicissitudes of the US regulatory regime. And so we think of the US as stable. I think a lot of the world thinks of it as unreliable. and unpredictable, I guess is a better way of putting it. You know, I think that's also true of other countries. I mean, India, for example, we invested in India in media companies at a time when there was no restriction on the amount of ownership that a foreign entity could have in an Indian digital media company. There was a restriction on the ownership of on non-digital media. But after we invested, the government just changed the rules, which has big implications for you if you're an investor, a foreign investor in a company. All of a sudden, you're part of the company's investment cap table that is inherently limited, and therefore it changes the value of what you own. India famously also did this thing where, Amazon launched big in India. There's another company there, another e-commerce company called Flipkart, which was eventually acquired by Walmart. And when both of them were foreign owned, the Indian government, out of respect for small Indian retailers across the country, they decided that they would impose a retroactive tax on those two companies.
Retroactive. I feel like at least in the US, you don't get retro usually.
Yeah, but that's true. So it's always more challenging being in different markets. But just to go back to, you were talking about like the many ways that you can exit a company before you had this call, sort of thinking about the various ways that we've exited companies. And we've exited companies because they failed and been wound down. And we've had no
The
values.
most common exit, right?
Mm,
I think that's probably the most common exit that people don't realize.
It
Invest
has been for us, but I think overall it is the most common. If you're a venture investor, you should expect that most of your investments aren't going to work. But there's also another sort of related thing, which is like the no value sale, where somebody will take over the company, its assets because they have something they can do with it, may or may not give you some shares in the resulting entity. Or they may just, and you at some level you're like, well, if it's going to get wound down, but somebody else has an idea of what they could do with this technology and people can keep their jobs, great. Let that go into somebody else's hands. Another thing that happened to us is we actually had a company that we thought was very promising and had a technology that was very sophisticated. And the founder was not particularly a good manager. In fact, he was probably a disaster as a manager. And we had not recognized that. He was a very good salesperson, especially he was very good at raising money. It turned out he was just not a good person to run the company he built. And so we got involved and we actually sold the company to another entity. And one of our other investors decided to block it because the entity, it was a buying entity, insisted on they didn't want to deal with legal problems. So they said they would only buy the company if all the existing shareholders agreed to sell it. And so one of the shareholders blocked it. So then we arranged to merge the company with yet another company, and that same shareholder blocked it. And over time, that shareholder, having blocked everything, nobody else wanted to put more capital in because the company was not going forward. That shareholder kept funding it and just diluted everybody out. So to the point where we were diluted down to just insignificance. We'd started with a 10% stake, and in the end, we had nothing. So it was effectively a write-off. So being diluted out is a way of exiting. We had one company that the founder recognized that his strategy was not paying off, wasn't working for him, and he gave us back half our money. He spent half the money he'd raised, and
well,
he
yeah.
turned the other half and closed the door. Which I have to say, as an investor, it wasn't ideal, obviously, but it showed a level of maturity that is sort of unusual among founders
Mhm.
because you kind of in your heart, you want to keep trying, like, come on, we can make this work. But if the founder's heart isn't in it, as an outside investor, you're never going to be able to power it through for him. And if the founder is not going to power it through, you might as well just get your money, get what you can out of it, because better to get half your money back than none of your money.
Yeah, that's unusual. In all of our exits, I've not seen that, but I do think
It happens in Silicon Valley from time to time, where there are a lot of serial entrepreneurs, and they just go down the road and they say it's not working, and they return capital and move on. Secondaries is another thing that we've seen, where a company there'll be an investor coming in, and maybe you want out because your fund is expiring or you've been in for a long time or whatever, and a new investor's coming in, things are going well for the company, but the company's not getting an exit. You could actually go to the company and say, "Hey, could we sell out our stake to the incoming investor?" And the company can do one of a couple things. One thing they do is they'll package the shares from the existing investor at a price that is below the new round. And for the new investor, it means that they're actually buying the overall pool of shares. Average valuation is going to be lower then the market valuation, the valuation they're going to record, the company's going to record the sale at. And the alternative is sometimes we've had this happen to us. The company itself will buy our shares back, hold them in treasury, and then sell them in the next round and make a profit on it. Because they'll buy them at a discount to the last round, and then they'll sell them at the next round valuation. Again, if a company's doing well, that kind of thing is possible. If the company is not doing well, it's probably not possible. And kind of related to that, there are a lot of firms now that exist that will buy secondary shares from employees or investors in companies that are hot. Every company in Silicon Valley that's reached a valuation of multiple billions, it's thinking of going public at some point. There's a secondary market in those shares. The market valuation won't be what, the next round or even the last round valuation was. But you can, if you're an early investor, you can recoup multiples of your original investment amount. And then I think the final two categories are acquisitions, where somebody buys your company. And I think this is more normal than any other form of exit, you know, because most companies are not going to IPO. And so acquisitions, especially in the SaaS business, and as an investor, you should always be paying attention to what the multiples are in any business that you're invested in, because it'll help you to understand what the potential valuations are if somebody acquires your company. Chances are, if you're we're never a major investor. We often own 5 to 10% of a company. So we're a meaningful investor, but we're not in a position to tell them not to do something, but we can affect the conversation in terms of valuation. Acquisitions may involve some complexity. They may involve, for example, an earn-out. Some companies will buy another company and keep the management and then put the managers on some kind of earn-out where the managers have to in order to get all their shares, they have to stay on for a couple of years. They may even be targets, and sometimes they'll wrap in the existing investors into that earnout. So you get your shares paid out. You get paid out only as the managers get paid out. So the acquisitions are big. And then finally, and the one that I think is one that everybody assumes is how people are going to exit, but is in fact maybe the rarest of the exits these days, at least certainly compared to failure and acquisition, is the IPO. And IPOs, as I'm sure you know, the number of publicly listed stocks in the US stock market has fallen, I forget the number, a third, a half over the last 20 years, in part because of the growth of private equity and private capital. And two things are happening. Private equity are taking companies off the public markets and operating them, and then trading them with each other, because private equity firms often trade companies among themselves. And then people don't want to list companies as early because there's a cost to being a public company. There's a cost. You have to pay auditors and accountants and public relations people, investor relations people. There's all kinds of costs associated with being public. And so a lot of companies, until they get very large, they're like, I just don't want to deal with all those costs. I don't want to deal with the headaches of dealing with the SEC and having lots of law firms tell me what to do every day. And so they stay public longer. I stay private much longer than they used to. There was the joke around Uber, I think, went public. I forget, it was the Series J or Series M. I mean, they had so many rounds of investment before they finally went public. And the valuations, as you know, some of these companies that went public in the last 5 or 10 years went public at valuations of tens of billions of dollars, which was shockingly late. Because in the old days, companies would go public at hundreds of millions of dollars, and then they would, public shareholders could ride the growth curve. And so as the number of public companies has declined, the IPO process hasn't gotten that much easier. You can still go public, even a relatively small company can go public, whether in a domestic exchange abroad, which some of our companies are, or they go public in the US. And we have 3 companies right now in the process of going through preparations for IPOs. Actually, that's wrong. We have 4 companies right now that are in preparations for IPOs. And all of them
US or other markets?
2 in the US, 2 not in the US. But they've all been in preparations to go public for at least a year or 2.
And then going back to the one thing that you mentioned, which I think resonates a lot with me and probably with a lot of other investors, is that I think people don't always think about doing diligence on the other investors in the deal when you're investing. Because really, whenever you end up exiting, those
Yeah.
people, like the guy you mentioned that was blocking a deal multiple times and kind of ended up ultimately like completely ruining your return on that, right? But maybe the company was doing well and you should have gotten a return. Like you made the right call to invest in the company, but the other people around the table kind of screwed it all up. And I think that happens more often than people realize. And I think that's why it's super important to just know and understand who you're investing with who controls the board and what their motives are and what kind of timeframes they have and, why they may or may not make certain decisions that could impact the actual exit you get to that point.
It's just it's I mean, it's super important. I mean, when you're investing in a company, I just wanna say again for the record, I made every mistake. If there's a mistake that could be made, I tried to make it because it's part of my education. And one of the things I learned too late was you should always ask a company, like, what their exit plan is. You don't wanna invest in companies that are not planning to be public. Like, there are some companies that the founder would like to have a nice residual. Like, once the company starts producing cash, the founder can live a nice life and maybe pay some dividends to shareholders or maybe not, depending on if the founder owns a majority of the company. So you want to know what their exit plan is, and you want to make sure they have an exit plan. And then you want to make sure that the other investors are aligned with that exit plan. And the other investors are willing to do what is in the best interest of the company and not always in the best interest of the other investors. Because the other investors, a big investor can really screw up all the small investors. And if you're a venture capital and if you're an early stage venture investor, unless you have the capacity to follow a meeting to participate in subsequent rounds and maintain your pro rata stake. And if a company becomes successful, those follow-on rounds can become very expensive. There's always a possibility somebody comes in at a later stage, a bigger investor, and in exchange for putting in a bigger piece of cash, may ask for special treatment. So, thing that you hear all the time today in the venture world, which didn't used to be nearly as prevalent, is structure. What structure means is, can I impose some requirements if I'm a vital investor coming into this company, maybe Series C, and Series B and Series C are hard for companies because they've started to grow. They may even have some, they get revenues and customers, this product market fit is becoming clear, but they're not maybe profitable yet. So they need cash to keep growing. And the early investors were smaller investors and don't have the cash. So they go to a bigger investor, a big Silicon Valley VC or some other VC, and the VC comes in and says, "Oh, we'd be happy to help you through this cash squeeze, but we would like to have a 2x liquidation preference, meaning that when the company exits, however it exits, that investor gets back two times their money before anybody gets anything." And if you're an early investor, notwithstanding the fact that you took all the risk getting involved early, maybe help the company founder to sweat through all the early challenges and figure out how to navigate life, all of a sudden you get shoved down the cap table or the preference stack, as they say. And you suddenly are less privileged than the person who showed up and all they had going for them was a bigger pot of money, which is why you see these Silicon Valley companies, Silicon Valley VCs raising ever larger piles of money because they want to be able to maintain their position, and they extract these preferences in exchange for being able to deliver large sums of cash. And it's capitalism. It's not ideal in some ways because you feel like it's not totally fair. On the other hand, it's one of the things that you should prepare for. And again, back to the exit question, if there's a lot of structure ahead of you, it can have a big impact on your performance. Because if a bunch of people came in with different liquidation preferences and some lawyers trying to figure out like the waterfall, who gets what, when, where, like that whole thing is complicated. And it can turn out that you could be an early stage investor in a company that's gone on to become a very big company. And still, when it gets sold or goes public, you might actually be not getting the best return ever. Whereas if you've held on to your some follow-on capital and participated, you will have done better.
Yeah, that is a thing that seems like it's become super prevalent and unfortunate. And we always try to keep our pro rata if we can, but we invest also smaller stakes in the company. And I think it's a little when you have a fund, like you're investing through a fund, so you have a set amount set aside for following. That's all you've got, right, for that fund. Whereas like we have a fund, but we also have the syndicate. And so in the syndicate, it's like people make their own choices, but that leaves sort of an opening for like if you want to keep your pro rata and you want to put more money in, there's another pool of capital, so to speak, to kind of do that and help. But
I think a lot of smaller funds will go back to their investors and say, "Hey, we have the follow-on rights to this company. It's doing great. You on a basis, you guys are all welcome to take it," which people will do. But I will say, in terms of like who you're investing with, the Silicon Valley venture capital world at one point was super founder friendly. They prided themselves on like helping companies. And the stories are legion of, early stage, early era venture capitalists in Silicon Valley helping a company to survive the difficult times and managing through and surviving. A lot of them today have these really big funds and they need deals. They need lots of deals coming in the door. And at the same time, they want to protect their returns because it's competitive to raise. And so they're what we have seen, I don't know if this is universal, but we've seen it a few times, is a big Silicon Valley venture capital firm coming in and trying to introduce structure earlier than ever before, some kind of liquidation preference, Series A. I don't know about seed, but very early on. And they take a kind of dominant position. They take a big stake. And this was probably most famously done, like frequently done by SoftBank. You remember when SoftBank, it
Oh
used
yeah.
to be the case that people would go to SoftBank and say, I've got this fantastic idea for a business. I just need to raise $50 million. This business is going to boom. And Masa Son, the founder of SoftBank, would say, I'll tell you what, we'll give you 75 million at a higher valuation, but we want the whole round or something to that effect, or we want liquidation. And so they would come in and they would suddenly become your partner on everything. And some of those Silicon Valley VCs could be great partners. Some of those Silicon Valley VCs could direct you places you don't want to go. I know a guy who started a social media company many years ago in Silicon Valley that did not become Facebook, LinkedIn, or Snapchat or any of the successful ones. He claims the reason it didn't work out, and he has many long stories to tell you about this, is because he had accepted terms from some of his investors. And when things got hard, his investors effectively ended up owning the company. And there were these participating preference shares and blah, blah, blah. And all these particular forms of investment allowed them to take control of the company. And he felt like they'd made a bunch of bad decisions. If you're a small investor alongside those people,
You're going down with them.
you're getting taken out.
Yeah, exactly. It's really interesting because we now have a number of co-investor relationships, you probably do too, that we know how they act in these situations and we just won't invest with them anymore, right? And others that we know how they act in a positive way and we share a lot of deals together and it's kind of nice.
I think there should be a website. You know that my kids go to college, they have Rate My Professor.
MyInvestor.com, I've always
Mm.
said,
There
always
should be
said.
ratemyinvestor.com and it should name names and let that, because I really do think there's a lot of investors who they are not founder friendly and they're certainly not friendly to other investors.
I totally agree. I don't know why it doesn't exist. People are probably afraid, but I think one of the biggest issues at the day when an exit actually happens. So another question for you, Marcus, because you have so many great stories. You've been through so many interesting things in this market across a long period of time, right? Like you're not new to this. You've been investing in good times and in bad times, and you've seen all sorts of things. But what's like the wildest thing that you've seen in an exit situation that you weren't expecting?
Well, I'll tell you, we had a very funny, I'm going to pick on India today because there's an election going on and Prime Minister Modi is going to win in a landslide, even though he shouldn't be the prime minister of anything. But anyway, so we had an investment in a very successful digital media company in India, and they were being acquired by another company in India, and they would not reveal any. And we'd been one of their first and biggest investors at the beginning, and the new investor and the founders, for reasons I still don't know, decided they would not communicate any information except that it was coming. It was coming. Valuation, terms, timing. They communicated nothing until the last possible minute. And then they would literally send something in the morning saying, this has to be signed by midnight, otherwise the deal's off every single time. And we would see nothing until, and then the best part, or my favorite part, was we signed everything. We read everything. We thought we understood everything. And we have a great lawyer in our company, Stuart Carl, who's a former lawyer of mine from the Wall Street Journal. He's a great media lawyer, but he's also become a very good deal lawyer. And we read everything, and somehow we didn't understand correctly that one of the documents we signed entailed us paying a fee to an investment bank who was involved somehow in the sale of the company. Now, I suppose it's possible that at the front end, if they'd said to us, "Hey, we're trying to sell the company. We think if we work with this investment bank, we pay them, 5%, we could sell the company at a higher valuation faster," and we all would have said, "Okay." But that wasn't what happened. It was at the very end, and it literally every every one of us was individually responsible for
And
paying
it was cash,
our
like in
share of the
cash.
investment bank. Plus they would withhold, plus they did this withholding thing. There was some kind of tax withholding thing that they wanted to impose on us, somehow involving the investment bank, and do not ask me the details. All I know is that transaction happened 8 months ago, and we're still discussing.
Wow, that's insane. I can't even I've never heard of that. I mean, was it a cash fee that they wanted you to pay? Or is it like pay a cash fee, but was the cash exit or was it
It was.
shares?
It was a cash exit.
Cash exit. So you could have technically you could pay it and then you get paid it back,
Yeah. But
theory.
we didn't know what the valuation was. We didn't know how
Like
much
no
money
one
we were
else
getting
cash you're
until
getting.
literally like 15 minutes before I signed the paper. We'd been given indications. It was sort of a range. And then part of it was withheld until later. And then it was just anyway. And what you learn is like, again, we're investing in many markets around the world, and different markets have different cultures and practices. I don't think this is customary in India. I think this was really just some very specific people operating a very specific way.
Yeah, because usually the banking fees get paid out of the company. The company pays for them. That's unusual. Yeah, it's so many different ways that these exits can go down. You just have no idea. I think that's part of the whole point of this podcast is that people don't realize like every exit is completely different. It's not like there's a playbook for each one. It's not like, there's some you can, I mean, to your point in the beginning, there's certain flavors, kind of what buckets they're in, but then within those buckets, there's more buckets and there's more gotchas and there's more.
I
uh,
think in the US, it's generally I mean, there's certain practices. Like there's companies that do. There's famously, remember that advertising company was for many years was run by Martin Sorrell, and he did an acquisition a week, and his whole thing was their comparative advantage in the media business, the advertising business, was basically knowing how to acquire and integrate companies. And people who sold it, like it was a playbook. Like you knew what you would get, you knew when you would get it. It was like straightforward. And we had one of our companies acquired this company called Open Slate, terrific company that it was in the ad space. It would identify brand safe places on Google and other digital video platforms. So if you were trying to put an advertisement on Google, you don't want your ad running against certain kinds of content that might be available on YouTube. And so you would use OpenSlate, and OpenSlate would make sure that your ads didn't run anywhere that wasn't brand safe for your brand. And
mhm.
so they were acquired by a company called Double Verify, which is actually a company that has also done a lot of acquisitions. And that process was incredibly like they knew exactly what they were doing. There was some kind of earnout. I forget how it worked. We got X percent in cash, X percent in stock. They told you when you could sell the stock. Everything was incredibly detailed. And I think in the US, among companies that are SaaS businesses or companies that are likely to be acquired by somebody who's a serial acquirer, I don't think it's complicated. I think in that world, it works great. But I think there's, as you say, the universe is wide and there's always a variation. And if you're not being acquired by somebody who's a serial acquirer who just does this for a living, there's always a potential for complexity.
Yeah, exactly. I mean, and it's just depends also the stage and the type of investor or the type of buyer it is. It's not always going to be a savvy buyer or someone that, it could be any flavor of anything. And I think the more people hear and learn about that, the better you can evaluate. You learn from all of the mistakes other people have made or gone through these experiences when you're making your own investments, or if you're a founder yourself and you're going to exit at some point.
Well, yeah, if you're a founder, I think in the same way that investors need to always start off by asking the question and trying to get an answer to the question, what would the exit look like? I think every founder has to think about that too. And every founder has to have a plan. And it may not be, the great Mike Tyson line, everybody has a plan until they get punched in the face, but you should have a plan and you should be adaptable, agile as the environment changes, and you should keep your investors apprised of your thinking. Because they, you know, most investors are not investing to be there forever.
Right. Otherwise, how
So
will
you
they ever?
owe it to them to communicate with them what your thinking is and how it's changing and what the timeline is and how that may be changing.
Exactly. Yeah. Couldn't agree more. Well, I know we're coming up on time here, so I guess any other final thoughts or key pieces of advice?
I would just no, I don't really have anything more than what we said. I think that, as I say, imagining and planning for an exit early on is really important. And if you work backwards from the exit, then it creates a whole bunch of other decisions you also have to make, like how much you reserve for follow-on. Do you participate in those follow-ons? Do you know do you allow if you have an ability to affect whether structure is introduced or not introduced? Do you encourage or discourage it? Who are your other investors? All these questions we've been talking about, like it all starts at the end. Like you want to have a successful exit. Then you go back and sort of address all the impediments and make sure that they're in your mind throughout the whole process.
Yeah, exactly. Like, yeah, I couldn't agree more. But thank you for doing this. I think this was
It was a
super.
pleasure. It's always great to see you.
Yeah, likewise. That's a wrap.